Medical costs and insurance premiums keep going up. Fortunately, there are some steps you can take to minimize the effects of rising costs. This tip will help discuss how health savings accounts, or HSAs, can help you manage some of those expenses and save money. Welcome to Money Tip Tuesday from the Making Money Personal podcast. Let's start by explaining what an HSA is. HSA stands for Health Savings Account and is very similar to a personal savings account, but money saved in the account must be used to pay for healthcare expenses. There is an exception to that, which will be covered in a bit. The good news is this is your money, so you get to control how the funds are spent and for which medical expenses. You can open an HSA if you have a high-deductible health plan, or HDHP. You can't if you're on Medicare, TRICARE, TRICARE for Life, or are listed as someone else's dependent for taxes. If you're self-employed and have an HDHP, you can get an HSA. If you switch jobs, your HSA stays with you. Since we've discussed high-deductible health plans, let's define the HDHP. In 2026, the IRS sets the minimum deductible at $1,700 for individuals or $3,400 for families. The total yearly out-of-pocket costs, including deductibles, copays, and coinsurance, cannot exceed $8,500 for individuals or $17,000 for families. There are many benefits to having an HSA. One of the most notable is the tax savings. HSA contributions are made before taxes, so they're deducted from your total income when it comes time to file. In 2026, the IRS lets you put in $4,400 for individual coverage or $8,750 for family coverage. If you're 55 or older, you can add an extra $1,000 each year until you turn 65 or enroll in Medicare. This extra amount is called a catch-up contribution. Money you take out of your HSA is tax-free if you use it for qualified medical expenses, no matter your age. Plus, any money your HSA earns is also tax-free. With an HSA, you also save on premiums. Most high-deductible health plans have lower premiums, so you can put your savings into your HSA. Use your HSA to pay for any medical expense, including coinsurance, copays, and your deductible. The great thing about this is your HSA is your money. You own all the money in your account, even if your employer contributed, and you keep it if you change jobs, lose coverage, or retire. Your balance rolls over yearly and never expires. If you're 65 or older or disabled, you can withdraw funds for non-medical use without penalty. Using your HSA is super easy. Open one at a bank or a credit union to get a debit card. Then use that to pay for expenses like copays, deductibles, and prescriptions. If you're interested in getting started with your own HSA, there are multiple ways to contribute. For a list of the ways you can contribute and a transcript of this money tip, check out Helpful Hints About HSAs at triangleuniversity.org. If there are any other tips or topics you'd like us to cover, let us know at tcupodcast@trianglecu.org. Also, remember to like and follow our Making Money Personal Facebook and Instagram pages to share your thoughts. And finally, remember to look for our sponsor, Triangle Credit Union, on Facebook and LinkedIn. Thanks for listening to today's Money Tip Tuesday. Check out our other tips and episodes on the Making Money Personal podcast. Have a great day. Eligibility and contribution limits are set by the IRS and may change. This information is for educational purposes and isn't tax advice. Please consult a qualified tax professional. Insured by the NCUA.